Hello, everyone, and welcome to the AB Disruptor Series. My name is Rick Brink, Chief Market Strategist within AB's client group. And if you joined us for previous Disruptor Series, first, thank you. Secondly, this is going to be a little bit different in two ways. First, generally in Disruptors, we take an important, timely topic in markets and then assemble folks to dive into it. And while I think today's topic is both timely and very important, to get to it, we're going to zoom out. Here in part one, we will look at an extraordinary period that has not only defined, but effectively created capital markets as we know them today. And I believe that how we got here has meaningful implications for where we go from here, both in terms of macro and market conditions, and ultimately what I believe it means for portfolio construction. And the second is just a bit of logistical switching of seats. Typically in Disruptors, I'm more the moderator, more or less connecting the dots and keeping the trains moving on time. But today I will be your speaker, which means, everyone, meet Jeremy Farrell. Jeremy has worked with me for years. He is my right hand, and amongst other things, he oversees the creation of our capital markets outlook. But today, Jeremy draws the unfortunate straw of keeping me in line. So Jeremy, welcome to Disruptors.
Thanks for having me. It's good to be here. And it's crazy to think, over the last 7 years of my career, this was the very first presentation I ever heard from you. So it does have a special place in my heart. But at the same time, it reminds me of two things. One, how old I'm getting, but also that there's a few iterations of this presentation. And before we get into the current one, let's go back to the origin and what inspired you to make Build a Better Path.
There are actually a couple of different, so the presentation itself was, as you know, created in 2016. That was the first actual presentation. But the seeds were from first 2013, around the time of the taper tantrum. We were starting to take away the punch bowl. And we were at the end of what I thought was a pretty fascinating period. And I thought what it meant for the future was going to be more challenged returns. But if I'm being really honest, it goes back to 13-year-old me. It's 1983. And my father had changed careers and he wanted to be a financial advisor. And so what that meant was every year on my birthday, all of a sudden, I would get books on financial history. I would get things on KKR. I would get, eventually over time, Den of Thieves, Barbarians at the Gate, all of that. And so I've always had an interest in history, but what started to happen is it became about financial history. And then, of course, I lived through the period we're going to talk about. I was born at the very end of 1969, which means, 0 to 10 in the 70s, my 10 to 20 in the 80s, and then 20 and beyond. And so a lot of the things we're going to talk about, those chapters lived through my childhood. So I sort of have them imprinted in my brain. So I think that's where it all kind of comes from. And then, from my career in fixed income and tracking the behavior of yields, which figures prominently in this story, that's the sort of the final piece that sort of puts it all together. So it's kind of eclectic, but it's a little bit my childhood, it's a little bit my professional life, and it's a little bit just my interest in history.
Yeah, no, it sounds like a lot of things, but you mentioned the word chapters. And it's true. When we look at history of markets, we oftentimes see a number. And stats can be a little bit misleading. And it could be a monolith. But you break apart this monolith. And so what are some of these chapters? And what are these chapters alluding to?
So this story begins for me. The markets, the way we know them, begin sort of in 1981, more or less. And at this time, there's an unbelievable, it's sometimes called the Great Moderation, but for me, it's a fundamental super cocktail. And it is a collection of historic ingredients that nobody planned to come together at the same time, and yet they do. And what would come from that is an unbelievable series of returns over a very long period of time, and indeed forms for me the greatest, longest, and strongest bull market in history. And so that's chapter one, this fundamental super cocktail. Okay, so what are the ingredients? Well, let me step back, because that monolith you mentioned is now the S&P 500 going back. It was incepted in 1957. And the average return is a little over 10% over all of that time, which is incredible. Rule of 72, your money doubles roughly every 7 years, a little over every 7 years. Unbelievable. But if I draw a dotted line that intersects 1981, then on one side of the line, the returns are significantly lower than on the right side of the line, dramatically so. And
I'm going to assume there was an event that happens right where this line was drawn.
If you ever want to turn a a dotted line on a chart into a tent pole around 1981, you just put 10-year treasury yields in. So what immediately jumps out is if I overlay treasury yields, you're going to see them rising throughout the 70s, as we know. They're going to peak right around that point, and they're going to start to fall over time. And as it does, first, you have this incredible decline in rates in a relatively short period of time on the back of a rapid decline in inflation. That's your engine. That's your original engine. And as rates fall, as you know, that makes everything go up. Exactly. Yields on bonds fall, bond prices, rise, bonds do very, very well. The entire fixed income complex, multiples climb on all stocks, cost of capital goes down, all sorts of things happen.
Everyone's winning.
Everybody's winning.
Exactly.
But the thing is that these four main ingredients are really the story. And the first is demographics. So the oldest baby boomer enters their peak earning years in 1981. They start to turn 35. So peak earning years are incredibly important, 35 to 54, because you are in your skilled years. And if you're talking about GDP is people and productivity, right? So what do we know about the baby boomer generation? It's the largest working demographic, or at the time was the largest working demographic in human history. It also had the highest female participation at that time. So you had the largest working demographic with the largest amount of participation across both genders. That alone would have been huge for GDP, the people part. But one by one, starting in 1981 for the next 20 years, every baby boomer would eventually enter their peak or skilled earning years, and that's productivity, people and productivity, right? What is GDP? There's Bob, there's a hammer, there's how good is the hammer and how well does Bob use that hammer, right? And ultimately that's GDP. So that by itself is massive. And we continue to follow the baby boomers' journey because it's impacted the economy and industries all the way through their lifetimes. It's happening again with healthcare and health span. But it's only one ingredient. The second is going to be the rise of automation, the digital age. Some people talk about one of the digital ages beginning in 1983. So think the personal computer, ultimately the internet. I like to think of it as Microsoft Office meets the internet. It's this exploding age of tech-driven productivity. That would be massive, but it's still not done. We also get the rise of China. December of 1979 is Deng Xiaoping's four modernization speech. That's the sort of unofficial entree of China making their way onto the world stage as the world's factory floor. Not the first made in Asia story even, but the largest. And so until now, in the headlines even now, that would become a massive story, hugely accretive to earnings for companies. That's why the companies moved over there. And that's still yet another ingredient. But the thing is, we got them all. We got demographics. We had the automation in the digital age. We had China, and we also had the top of the roller coaster. You see, in order to have rates come down from a really high level, they have to get to that high level in the first place. So you also needed the 70s. You needed this incredible, historic, again, unprecedented period.
People love to talk about the 70s, whether it be inflation. And so I know you have thoughts on the 70s, and I'll let you opine a little bit on that.
Well, it's just that, every time we ever talk about inflation, and we hearken back to these really difficult inflation periods, it's the only period we got. It's the only one we have to go to. It's a sample size of one. And so when I talked about growing up in the 70s, I was sitting in the back of a car waiting on odd and even days for gasoline, right? So I felt what it was like to have a Middle East crisis and impact gas at a really acute level. And so it's that period that allows the Fed funds rate to get to its highest level of all time by a long, long, long shot. And trivia questions, I turn back to everybody. Do you know what the peak of the Fed funds rate was in the early 1980s? 18 to 20%. That was the range, a 19% midpoint. The 10-year Treasury got up into the mid-teens. That's roughly where inflation was kind of sitting. So at the top of the roller coaster, if you can find something to break that, then you're going to cause inflation to come down and rates to come down. And you had an incredibly potent cocktail in the form of globalization and automation. And as you know very, very well, as a person who does a lot of work on the inflation side, you had a period of not just disinflation in goods, but outright deflation for a very, very long period of time. So it's that combination of ingredients all together that ultimately result in rates starting to fall very, very rapidly and markets start to rip. And they will do so for almost 20 years. So if we go back to that idea of the dotted line and we think about the returns on the left side and the right side, on the right side, we have 12% a year for that 40 plus years. On the opposite side, we have 9% a year. That's a huge difference. But in this 18-year period that starts in 81 and ends around 2000, the S&P 500 would average over 18% a year for nearly 20 years. Rule of 72 is your money doubles every 4 years. A 60-40 would do 16.5% a year for nearly 2 decades. This is the origin of our entire industry. I've done work on this several times in the past. I can explain the growth of our industry in assets, the number of jobs, the compensation that we all make, all of it. The wellspring is right there as markets start to take off. But the thing is, over time, some of those ingredients start to fade. The oldest baby boomer exits their peak earning years once they turn 54. The gains from falling rates, once we got to the tech bubble, the Fed funds rate got down to 1%. And a lot of the productivity gains had smoothed out. It was really only China globalization that continued to pace as China entered the WTO. But it's there that the transition really happens because just a lot of the major ingredients lose steam.
So it sounds like all good things must come to an end. And that takes us to about the year 2000, right? I'm a few years old, and then all of a sudden, something happens.
One of the things that takes place as this transition is going on, as rates are coming down, is we start to replace a lot of the organic drivers with pushing. So think debt, think multiple valuations, think all that starts to show up on the scene. And you can track that through things like household net worth to GDP, debt to GDP. You start to see that rocket up. In fact, one of Buffett's favorites is household net worth to GDP. And for decades, it stayed within this range. But you can see it start to explode upward, and it hits a peak and it crashes into the tech bubble. But I call the second chapter the twin crises, because then we start to make our way back up and we get the GFC within a handful of years, and then the market collapses again. So the second chapter is really, we've lived and gotten accustomed to markets driving at incredibly high levels. It's courted all new types of investors, all new types of offerings in the space, but eventually the drivers behind it are fading. We think push things a little bit more mechanically, and we pay the price effectively in the form of 2 major crises. And that's chapter 2. And this is sort of where the origin of Build a Better Path comes from, is for the first time, arguably since the Great Depression, we uncork a massive level of fiscal and monetary stimulus in support of industry, but also in support of markets. Now, a lot of us are vested and invested in that space. And so chapter 3 is the great beta trade. And there are lots of visuals that really illustrate how much of stimulus we put into it. But going back to the household net worth to GDP chart, that's where we start to rocket back up again. From a market perspective, the other really interesting visual is the Fed's balance sheet against the S&P 500. In our industry, data sometimes is really hard to interpret. Sometimes it's easy to interpret. If you have those two lined up against each other, it tells you a very clear story. One, if you put $1 gajillion into markets, markets go up. And number 2, if you stop putting $1 gajillion into markets, they start to go down. And that's where that 2013 seeds came from, the taper tantrum and the market's reaction after that. And so it's here, right around this time, 2016, where I create the first iteration of Build a Better Path, because the idea was, okay, chapter 1, the fundamental super cocktail, the ingredients start to fade. Chapter 2, as they fade, we push a little bit too far. We get 2 humdingers of downturns. We ride to the rescue with historic fiscal and monetary as we come to the close of chapter 2, which takes us into this great beta trade where markets rip to those higher levels again, but not necessarily on organic fundamentals, but more on the support that comes behind it. And the idea was, as we take that away, GDP was falling. It would be cut in half in the following decades. Multiples were sitting at really high levels. Rates were at very low levels, generally speaking. And so what was going to be the horsepower to generate the level of returns that we'd become accustomed to? And I just didn't think it was there. And so I believe that the chapter going forward for us that would persist for some time is a world where the market is left to its own devices without fantastic drivers. And as a result, returns are going to be more moderate. And so as investors, if we cannot rely on historically high levels of returns to get us home, now let's think in terms of the person trying to save for retirement, right? And we're trying to make money last over time. If we can't rely on the level of returns, then what I put out is it has to be about the sequence. And so I went out and talked about it, and I nailed it for all of about 2 years.
And that was the origin story. That was the whole inception of this all. But to your point, something happens in November 2016 that changes everything.
That's right, because over that 2 years that I cherish, over those 2 years, there is a day in November of 2014, November of 2015, and November of 2016 where the S&P is basically at the same level. But the day in November of 2016 that it's sitting at that level is the day of the 2016 presidential election. And then we introduce an unintended but no less potent additional combination of fiscal and monetary, because ultimately we get the Trump administration tax cuts, and then that gets followed up by the Fed's reversal. For those that might recall, there was a time where Powell said, not only are we not done tightening, but we have a long way to go, and markets ate themselves, right? And then as we got into the turn of the year, in another historic occurrence, the Fed goes from we're going to tighten to we're not going to tighten to we're going to cut. And the next thing you know, they're cutting and markets rip. And 2019 becomes a really interesting year because the S&P is up around 30% as memory serves me, but S&P earnings growth was 0.6%. So again, this idea that you can have really strong returns, but it is not originating from organic drivers, right? And so for the second time, we have massive fiscal and monetary stimulus, just not necessarily planned, but nonetheless showing up on the scene right around the same time. And this is where, for dramatic effect, I throw up my hands and I say, okay, this is it, right? We had this fundamental super cocktail and it failed and it faded. Then we pushed too hard. We got two historic crises. Then we rode to the rescue with dramatic stimulus, but then that was taken away. Now we have this sort of unintended stimulus and that drives market. This is it now. Now we are left to our own devices because it would take something absolutely historic to create the impulse that would be needed to drive markets yet again. And so, as I sometimes joke, unfortunately, I sort of created COVID, because then we come along with a package that makes the GFC look absolutely quaint. And once again, as we're buying almost everything that isn't nailed down across the capital spectrum, we get another historic occurrence. And if I go back to that household net worth to GDP chart again, and you have that range that it's sitting in for decades, and it spikes higher into the tech bubble, comes down, spikes higher into the GFC and comes down, and spikes higher into COVID, that COVID spike looks like a vertical line. When we tried to put it into presentations, we couldn't even graph COVID because the household net worth to GDP at the peak would have been up in the title space of a PowerPoint slide. That's how extreme the stimulus was, but again, markets reacted. And so if that was the only thing that had happened from COVID, that we uncorked the mother lode of stimulus, and as a result, it had an impact on future returns, that would have been consistent with the last 15 years. And of course, what I mean by impact on future returns is when you're not organically growing, when you are basically using debt to drive up multiples and support markets, it has the effect of taking returns from the future and paying them into the present. Yeah. Well, if I'm taking returns from the future and I'm paying into the present, then by definition, future returns are lower. And so we have, like many firms, engines that will forecast forward returns over time. And you see those declining sequentially over that 3-year period, sort of 18, 19, and 20. So again, it brought us back to this same question mark. On the other side of all of this stimulus, what's an investor to do?
Especially if we're looking at a 60-40 here, which classically we do. And if we look at the 60-40, to your point, the equity returns, while maybe higher, the bond returns were falling and falling and falling as inflation fell, right? But that all changed with the pandemic and some events that have happened since.
That's absolutely right. But to set the stage for that next thing, I want to go back a little bit. So we talked about retirement. Look, most people that invest for the long term, for something into the future, and for a majority of folks, it's retirement. I want to introduce the Bengen rule. Now, many folks in our industry are familiar with it. Bengen, a financial advisor back in the day, in '94 comes out with a recommended withdrawal rate that someone can use that will last over time. He studied history, drawdowns, significant drawdowns. And the punchline is he comes away and says, look, you can take out 4% from your 60-40 portfolio, or from your portfolio, and inflation adjust those withdrawals over time. And according to what I've studied, it will get you home. It will work for you. Like initially, it was a 20-year window and then expanded to a 30-year window. And so a lot of the work that you and I do, of course, is using that as a marker, running simulations around how retirement worked out over time periods, how it might work into the future. And so, of course, there's the hypothetical retirees of different cohort years. So let's take someone that retired in 1981.
Oh, before we do, I have to say, this is my favorite game to play. And so because we've been doing this for a long time, we've spoken to a number of audiences. And one thing we love to try to do is ask the audience, okay, well, with this rule in mind, how much money do you think? And again, let's set the stage. Let's imagine you have $1 million and you're withdrawing 4% inflation adjusted, right? How much money do you think you'll have after 30 years of retirement? And so we say, hey, raise your hand if you think over $1 million, and then raise your hand if you think under $1 million. And almost every single time, about 95% of the audience guesses under. But in fact, the answer is really...
Let's play along at home. What do you think it is? You retire in 1981, 4% a year, inflation adjusting it. You go 30 years. You've been spending for 30 years from your original million. How much do you have left? And the answer is $13 million.
So you're 13xing your money. Whether it's $1 million or $2 million, you're multiplying that by 13 times.
You started with $1 million. Yep. So incredible were the returns of the fundamental super cocktail and everything that followed, that you started with $1 million, spent all the money you were supposed to spend according to the rule, and were 13 times your money at the end. At that rate, you can live multiple lifetimes. But over time, those returns start to come down. We talked about them fading. So if 1981 was sort of, this kind of a slope of performance and where your portfolio got to, the 91 cohort was still incredibly strong, but it was down meaningfully from where the 81 cohort was. And then when we got to 2001, it's still great because the 2001 isn't all the way through this 30-year period, but they were sitting at about the amount they started with, which is still tremendous, right? But as we get down to those lower levels, it becomes easier to kill a plan. Sequence of returns becomes much more important. The number one way that a plan dies is you have a significant drawdown in the early years of retirement. Asset prices come down. You're forced to sell impaired assets. You fall behind the 8 ball. And ultimately, for all intents and purposes, your plan is dead. Unless markets stage some incredible comeback over time, you've sold your way out of your retirement plan working. And so the thing is, though, in all of these periods, it's almost impossible to kill a plan. But one of the examples that we talk about is if you go back to 1990, 1991, and you take the actual return stream that went, but you increase the withdrawal rate. You take it up from 4% to 8%. Yeah, you still have a great end of 30-year period amount. You go from $1 million to $2 million. So the rules of our game, we've doubled the withdrawal rate. We make it 30 years. We have twice the money we started with. But at that point, all I have to do is take 2008 out of its natural place in the sequence, make it the first number in the sequence, take the first year of returns in the sequence, put it into 2008 slot, and you do not go 30 years and end with double the money you started with. You make it 25 years and have zero.
And all from just switching those 2 years.
2 years.
That's it.
Right? And so again, I know we increase the withdrawal rate meaningfully, but just think of the juxtaposition of doubling your money and lasting, going 30 years and doubling your money and going 25 years and having nothing. That is the big point about this. And then we have a 2011 cohort that we're doing right now. And 2011 cohorts are really interesting because I call those the stimulus retirees, because these are folks that are clear of the tech bubble. They're clear of the global financial crisis. What they settle into when they retire is this period of just stimulus. They settle in with GFC stimulus in the markets. They will eventually get the unintended pairing of tax cuts and the Fed's reversal, and they will get the GFC funding that drives markets still higher. And so the interesting thing is the 2011 cohort pops back up onto the track and looks more like a 91 retiree than a 2001 retiree. But again, there is a cost that comes in terms of expected returns as we go over time. So now let's put another dimension on this. Another thing that many firms do is the 10,000 Monte Carlo simulations thing, where returns, economy, growth, et cetera, everything gets forecasted through multiple simulations, through building blocks, et cetera. And it spits out over those 10,000 simulations how many make it the 30 years, how many don't, and then you get a probability that the plan wins or the probability that the plan fails. A couple of interesting things start to happen. So let's go back to 2008. I talked about the stimulus retiree and how they pick up the stimulus from the GFC. Let's go back to somebody at the end of 2008. That person, the model is picking up on mean reversion. Everything's been depressed. It thinks it's coming back. It sees 7.5% returns in a 60-40 over the next 10 years, something similar over the next 30 years. And so interestingly enough, if you run the probability of plan failure, even though we're right in the thick of the GFC, everything is getting picked up, it spits out a failure rate of 3%. So 97%, Bengen lives.
Fantastic.
Right? Fantastic. We're good.
Yeah.
Right? But again, as we keep going forward, the probability of plan success starts to come down. And notably, in the years as tax cuts, Fed reversal, each one of those, if you look at the expected returns sequentially year over year, they slowly keep coming down. And so in 2019, at the end of the year, we reran the probability of plan failure. So 2008, end of the year, 3%, 2019, end of the year, 27%.
So what you're saying is there's a 1 in 4 chance I end up homeless in a box.
Yeah, there's just imagine that conversation.
Pretty sobering, yeah.
There's only slightly better than 1 in 4 chance you're going to end up living in a box at some point in your lifetime. That's probably not the most inspiring. So that was a big, big thing.
Yeah.
And then COVID hits. And then we have the massive stimulus that comes after. And so this takes me back to, if it was only bringing down returns, we would be talking about the failure rate climbing. And indeed, if you reran the probability of plan failure into the end of 2020, after all that stimulus took effect, the number was in the 40s%. Fail. You were getting towards a near coin flip based on what everything had gotten down to. And the reason for that really rested in, strangely enough, equity expectations coming down, but it was really a bond story. Look, 60-40, the whole idea, its whole genesis was that you have pro-cyclical and counter-cyclical stuff. Equity does well when things are going well, bonds tend to do well when things are not going well, et cetera, et cetera. They tend to offset each other, and history shows that, especially out of the 80s and into the 90s when bond yields were really high. If we had a drawdown, bond returns were very strong and played a role of offset. And when there wasn't a crisis to see, the real yields, the inflation-adjusted yields that bonds were throwing off, was very potent and was a strong contributor to success inside of the portfolio. But the other side of the coin is, over all of these periods, as inflation came down, as rates came down, as we had crises and stimulus came into play and the rates continued to fall, inside of models, bond expected returns specifically were starting to plummet and fall into very difficult territory. So at the end of 2020, the expected return of bonds was 0.2% for the next 10 years, but the expected inflation rate was 1%. That means that your inflation-adjusted expectation for 40% of your portfolio over the next 10 years was negative 80 basis points. Nobody in their right mind would start out of the gate and say, I have a great idea. I'm going to put 40% of my portfolio into something that I think will have negative real yields and therefore negative real returns over a 10-year period. And yet that's where we sat. And so if we were having this conversation at the end of 2020 and talking through what someone would do, we were identifying bonds as the weak link, and second only to the significant drawdown in the first 10 years. It was the reason why plans failed. And it was the reason why the fail rate jumped up to the level that it did. That was the killer. It wasn't the equities. First 10 years followed by the behavior of debt. And this is where the second part of COVID comes into play because this was historic to me. Inflation had basically been dying. The model that I just talked about had 1%. But what shows up on the scene is something that I call the era of exogenous inflation shocks, otherwise known as the League of Inflation Supervillains. If you think of the greatest inflation shocks in history, you're going to come up with pandemics and war and global tariffs, etc.
Keyword history, though, right? This could be over hundreds of years, 100 years, but it's a long period of time.
They're all very, look, the average distance, if you take the average distance in time to get to the greatest inflation shocks that we've had over the past century, the average distance is 82 years. So think in terms of the global pandemic, 1918, the reopening, which pressured prices just like it did in COVID in 1919. In Europe, the last European land grab is World War II in 1945. Now we have Russia, Ukraine. We have something that we talk about more in the US, which is housing lockup or lock-in, as interest rates sort of supercooled and superheated and locked up the market. And so for a long time, we were talking about housing services as the big driver of inflation. Then we had the imposition of global tariffs since 1930. That was the last time. And all of those ripple through every component of CPI. So if it looks like we can't kill inflation over all this time, it's because it starts to come down and it would get triggered with the next thing and the next thing. So the average distance, 82 years, but all of these happen back to back to back to back within a 5-year period. And now, of course, as we talk about this, we're talking about the Strait of Hormuz as, at least for the moment, a 6th version of that. Why does that matter to somebody saving for retirement? Why does that matter for portfolio design? Because it caused a reversal in inflation. We got to one of the highest levels of US inflation outside of war in history. And with it went Fed policy and rates. And suddenly real yields drove right back up again. And so when we ran the probability of plan fail 5 years later, it had fallen from that 40% down to 15%. And once again, the sim hero, as we call it, wasn't equities. On an inflation-adjusted basis in 2020, 2025, they had roughly the same expected real return over a 10 and a 30-year period. It was bonds that went from that negative real return that was being expected to a strongly positive one. And so where bonds were the killer in 2020 outside of the drawdowns, it became the savior after that. Which means as an investor, one of the things we've talked about is what can we learn from this? What should we take away? Because if inflation, as it does ultimately turn out to be, wait for it, transitory, as all of these make their way through the system, Powell himself said, were it not just for tariffs, we'd be back to 2.1, then yields will follow with it. So from a portfolio perspective, we talk about managing duration now for that reason. Take a position, capture either the real yield or capture the capital gains that would come from falling yields should that occur. The second is the model is looking at high levels of inflation, so have an approach. And then the third is to be thoughtful with the S&P 493. Right? We all talk about AI and different views on what it means for markets, what it means for the economy over time, but we're all invested in it. And a lot of the time, conversations around the 493 falls to the side. And so the other takeaway is to be intentional with the S&P 493. And that's what leads us to some of the ideas in terms of portfolio design. All right, so what do we mean by intentionality with the 493? We've grown really accustomed over a long period of time now that if something goes really wrong, that we will ride to the rescue with stimulus. And it's rescued markets. The question is, what if we don't? The global financial crisis had its own reasons for why it needed to be done, and it was implemented. We had the unintended coupling in the middle, and COVID, of course, almost demanded it. If people were being forced to stay at home, couldn't go out, it had to be done. The question is, what's the hurdle rate? What's the hurdle now to step in on the next crisis and uncork the mother lode all over again? I mean, we just had, Warsh had a confirmation hearing that he was in talking about what he would do. And again, he made it quite clear that the Fed should stay in its lane. He talked about bringing down the balance sheet, sort of getting away from the idea of the fiscal and monetary coupling. And that's really interesting because the last time that we had a major drawdown in markets and we didn't do anything about it except cut rates was the tech bubble. And I think we lose sight of just how long it took to fully recover from the tech bubble, particularly given that the GFC followed in the years, 7 or 8 years later. So here's my next trivia question for everybody. After the S&P declined with the tech bubble, how many years did it take before the S&P got back to its prior level and held it? And the answer is 13 years. In 2013, following the taper tantrum, as we went through the back end of the year, markets recovered and rose and passed the level, and they would hold it. The NASDAQ would take 15 years. My father is one of the oldest baby boomers, born in 1946. And so when the tech bubble hit, he was 54 years old, right? He'd been riding along this incredible wave of performance, probably thinking, what island am I going to buy or something like that, 54 years old. And then suddenly the S&P would basically lock in place. And when he looked back up and it was back to the level that it had been prior and held, he was 67 years old. This is the thing that I think about all the time. And I said this earlier, in the absence of a level of returns, it's about the sequence of returns. What I have believed and talked about ever since we created the first round of Build a Better Path in 2016 is I believe that can absolutely be done. And the way that we can do it is by focusing on parts of the market that persistently generate strong sequence of returns. There's no voodoo to it. There are reasons why it does. But we talk about up-down capture a lot as the language of that, or the metric of sequence of returns. And imagine if you think about the S&P's performance over all these decades, it's been remarkable. But what might surprise you is if I could create a portfolio that only generated about 90% of the up capture of the S&P, but 80% of it's down, just that 10-point difference, if you will, or a ratio over 1, which I tend to think of it as. As strong as the S&P performed, a 90 up, 80 down portfolio basically throttles the S&P 500. And if I dip into the hedge fund world, where into long-short equity hedge space, back when we first ran it, you would see a lot of cohorts in this sort of 50-25, 50-20 range. And if you put a 50-20 up against it, easier said than done. But should that get pulled off through, say, a hedge fund world, it generates a return over all these years that's nearly in line, almost identical to the S&P 500. But back to the idea of sequence of returns, the line is very, very smooth. So for me, for a long time, it's always been about, first, to ask ourselves a question. What are we investing in service of? What's the end goal? And then if the answer is, I want to fund retirement, I need money to last into the distance, then I think sequence of returns, if I have to assume that we're going to be left to our own devices largely over time, demands that we start to embed some of these ingredients, or as I call them, better betas, that persistently have good up-down capture to benefit the portfolio. And then, of course, there's a discussion of how they go together and how all of that can benefit the portfolio over time. Now, if I'm wrong, and the next time we have a drawdown, and we drop all the stimulus all over again, then nothing to see here. Everybody's fine. You're all going to retire beautifully. It's not going to be an issue. But the thing about retirement plans is you cannot fix them halfway through. When they're dead, they're dead. And we go back to the example we gave from the early 90s. That is what we're trying to talk about all of this in service of. Can we be intentional with parts of the portfolio so that we can impact the downside? We can mitigate to the best of our ability what that looks like, because if a significant drawdown is the way you kill a plan, the way that you save a plan is to lessen the amount, the magnitude, or the severity, the amount of time that you stay underwater. And if I can do both, and one would hope they would go together, then all the better, right? So where we're going from here is going to be exploring all of that. Look, if I recap this, again, my whole life has been living in a period where we've had historically strong returns. It began, as we talked about, with this unprecedented, unplanned combination of ingredients around globalization and automation and demographics, all of them showing up on the scene, some other ingredients underneath the surface, and it would power our industry. It would power our expectations of returns inside of financial markets that even now persist, but it would also fade. And then we would eventually push into that through the debt and the multiples I talked about. We'd find our way into some downturns. And in the last 15 years or so, 15 plus years, we've gotten into a space where stimulus has come and save at the worst of times. But as planners, as portfolio constructors, I think we have to start to think or plan for the idea that it doesn't appear again. And going back around to the three linchpins that came out of this, one is it's going to be thinking about real yields, both in the now and on an ongoing basis. It is going to be, do I think about inflation as having a regime change? But for me, the biggest and most potent ingredient is, how do I think about portfolio factors or betas that can help change the return path over time through decumulation, right? If we're in accumulation, or if we never had cash flows to deal with, then the path of returns doesn't matter. But the moment you introduce cash flows, they do. And so for you, sitting through all of this, I know this has been a bit of a journey yourself, and you've had these conversations. What comes out of it for you?
Well, I think it all goes back to the original sort of intro that we had about this, about how, in general, when you talk to people inside and outside the industry, and they say, okay, well, I feel pretty good about my retirement. The S&P's averaged 10+% for many, many years. But what I love about this discussion is that it says, hey, look, it has. But again, there are chapters to this. There's decades to it. There's years to it. And all of those have a rhyme and a reason for what they do. And so I think it gives you a good perspective on, as we sit here and look ahead, and we say, okay, it's fair to say returns will be they'll be good. But at the same time, when we look at the history, we also understand there's nuance to it. There's a little bit of reason behind actual movements. And so going forward, it's important to be aware of that path. And so it's more than just the level, right? It is the sequence. And so for me, that's my main takeaway. And as I have hopefully another 30 to 40 years before I actually retire, and AI doesn't change all that, I embrace the challenge. But for those that are facing it today, hopefully that they'll take away some things from this, and they'll come to the next one to learn more about the better betas.
Okay, one last thing. At the risk of wading into a thorny subject, we talked a little bit about Kevin Warsh. Politics clearly are going to play a role through all of this. One of the things that I say about this period of time is that I can explain every election in the developed world as a result of the byproduct of the fundamental super cocktail. The lost in the strong earnings and everything else is that you see a big wealth and income gap that starts to form. And I can go back election over election over election, going backward, both, as I said, here and abroad, to explain or talk to where those drivers come from. And they start early in the 80s. So if I look at corporate profits back in time versus wages, back in the early 80s, the line was more or less on top of each other. And if you see it, it springs and gaps apart like a monster over time. The amount of compensation that someone made as the premium that someone would get for having a college degree versus having a high school education or less. Back in the 70s, if you were a high earner, it was probably just as likely that you didn't have a college degree. But again, the same thing happens as we get into the 80s. That gap's apart. From the Gini coefficient, the classic measure of haves and have-nots, it basically spikes and goes vertical. And when it starts to spike and go vertical is in 1980. So policy as we go forward is also going to play a big role in outcomes for everyone. When we talk about retirement, a retirement plan is only one leg of the stool. So I'd be remiss if I didn't bring that all together, because Social Security, for example, all of that is going to be Medicare, is all going to be part of the retirement story. But what we have the most direct control over, again, is the portfolio itself. And so with that in mind, what we're going to do next time, normally I'm not a big cliffhanger guy, but it's on this idea of policy, sequence of returns at a high level, and how we get here, that we will conclude for today. But here's what's going to follow. First, we're going to start right back here and dive into some examples of better betas. We'll discuss what creates that persistency of return sequences. It's not voodoo. As I said earlier, there's a driver behind it. And importantly, we'll quantify the impact of these ingredients on the probability of retirement plan success through things like Monte Carlo simulations. It is really eye-opening to see small changes change probability by 300 or 400 basis points. We're also going to look at other factors in improving outcomes. As you can, if you can think about it, there's also efficient structure, how we put betas together to create maybe a whole that is greater than the sum of the parts. There's a little bit of alchemy that you can create doing that. And finally, alpha. I know alpha can be a bit of a charged word sometimes, but in reality, a little bit of alpha, whether it is investment or non-investment driven, like structure, goes a long way in determining retirement plan success and terminal values. You would be, again, surprised. Most of the time, 20 or 25 basis points of alpha by hook or by crook can generate $300,000 of additional value in a portfolio by the end at the terminal level. And so we're going to share that and how that plays in as well. And then there's another angle we want to come at this from in another episode, and that's going to be how to share this information, how to communicate it to investors. We're often fixed in the moment when we're investing, what's performing well, what's performing poorly, et cetera, et cetera. Part of Build a Better Path and its adoption has to be around the idea that the investors that we serve are comfortable with attending to the path and the sequence more than just the level. See, I have the easier job of talking to financial professionals like you. But you have to, most of the time, many of you listening, have to turn around and explain it to folks that maybe don't do what we do for a living. And so we want to make sure that we spend some time there. The path only works if we stay on it. A lot of that's going to come. I'm really excited to bring it to you. But for now, thank you as always for joining. I hope you found this interesting. And we are really looking forward to bringing you part 2. And Jeremy, thank you very much for being a part of this.
It's great to be here. I'll relinquish the seat back to you for next time. But again, thank you.
Thank you. We'll see you next time.